in the intricate world of finance. The income statement spotlights a company's financial performance. And at the core of the income statement are two foundational accounting principles. The revenue recognition principle for the top line or revenues and the matching principle for expenses. These principles are not mere technicalities. They are the bedrock of financial integrity, ensuring that a company's financial narrative is both accurate and transparent. By adhering to these guidelines, businesses can present a true portrayal of their performance, fostering trust and confidence among investors, stakeholders, and the broader financial community. The revenue recognition principle dictates that revenue should be recognized when it's earned and it's realizable, irrespective of when the cash is received. This ensures that financial statements reflect the true economic activities of the company. For example, Cisco Systems, a global leader in networking hardware, offers customers a combo package that includes hardware, which is networking equipment like routers or switches, and a service contract, let's say a 3-year maintenance and support agreement. Now, as per the revenue recognition process, for the hardware, revenue is recognized immediately upon delivery and transfer of control to the customer. But for the services contract, revenue is deferred and recognized over the 3-year service period, reflecting the ongoing obligation to provide support. Another example, for service revenue, let's say Accenture. A global consulting firm recognizes revenue from advisory services as they are rendered. For instance, if Accenture enters into a contract to provide consulting services over 24 months, it recognizes revenue monthly as services are delivered, even if the client paid upfront. Another example, let's say Starbucks. Sells gift cards to customers, recording the proceeds as deferred revenue. And revenue is recognized when the gift card is redeemed for products or services. For airlines, let's say customers often book flight tickets in advance. But let's say Delta Airlines would recognize revenue from ticket sales only when the related flight occurs, as this is when the service is rendered to the passenger. Now let's talk about how do we deal with long-term contracts. Now Turner, a major construction company, undertakes large-scale projects like building infrastructure. So for a 2-year bridge construction project, Turner would use the percentage of completion method to recognize revenue. If 60% of the bridge project is completed in the first year, 60% of the total contract value would be recognized as revenue that year, reflecting the work performed. Next, we've got the matching principle that requires that expenses be recognized in the same period as the revenues they help generate. This alignment ensures that financial statements accurately depict a company's profitability. Let's talk about cost of goods sold or COGS. So let's say Walmart purchases products from suppliers to sell in its retail stores. Now, when Walmart sells a product, it recognizes the revenue from the sale and simultaneously reports the purchase cost of the product sold as COGS in its income statement. This practice matches the expense of the sold products with the revenue they generate, providing an accurate picture of profitability. And whatever products are unsold, whether still lying on the shelves or in the warehouses, are reported as inventory on the balance sheet. Let's say Goldman Sachs, one of the world's largest investment banks, pays annual performance bonuses to its employees based on the year's profits. Even though bonuses are disbursed in the following year, Goldman Sachs would record the estimated bonus expense in the same fiscal year the related revenue is earned, matching expenses with revenues. Let's talk about depreciation expenses. So let's say Caterpillar, a manufacturer of construction machinery, invests in expensive equipment for production. If Caterpillar purchases machinery for $1 million with a useful life of 10 years, it doesn't expense the entire amount immediately. Instead, it allocates $100,000 annually as depreciation expense over the machinery's lifespan, matching the equipment's cost to the revenues it helps generate every year. Let's say Ford Motor Company offers warranties on the cars it sells. Now, the estimated cost of warranty repairs is recorded as an expense at the time of sale, matching the expense to the period in which the related revenue is recognized. So, grasping and applying the revenue recognition and matching principles is crucial for accurate financial reporting. These guidelines ensure that income and expenses are recorded in the right periods, offering a true reflection of a company's financial performance.